overnight. The Dow was up, meaning our futures are pointing in the right direction. The Aussie dollar flat at 66.2 US cents. Brent crude at 84 US dollars a barrel, and gold up $3 in value. For more on finance, let's bring in James Gerrard from the Financial Advisor website. James, good morning to you. So we're having this two-day meeting of the RBA board finishing today, keenly awaiting what they say. How is it expected to fall from your perspective?
Good morning, Michael. Well, the share market's betting on no change, and they've put the probability of an interest rate increase at only 3%. So it's likely that the Reserve Bank's going to keep the interest rates on hold today at 4.35%. But one thing that has changed over the past couple of weeks has been the outlook with regards to how quickly interest rates are going to drop later this year. So we've seen inflation falling, but not by as much as what people had hoped. And so the banks have revised their outlook. Commonwealth Bank, who had previously said we're going to see three interest rate decreases this year, have revised that down to only one decrease later this year, and that's in line with what the other banks are saying. And we've got one bank who's an outlier, that's Judo Bank. They're actually forecasting three interest rate increases to move our cash rate in line with that of America, UK and New Zealand, who all have cash rates above 5%. But if you speak to the average person on the street, they're finding it difficult because we've had 13 interest rate increases over the past 2 years. So I don't think we're going to see those increases. And if you take Sydney, for example, the average house price in Sydney is $1.6 million. So for the average person who buys a house, they have 20% deposit, that's a $1.3 million debt. Now, when interest rates were 2%, that was $5,000 per month mortgage repayment. But now with interest rates at 6.5%, that's $8,000 per month. That's a big increase, $3,000 per month for the average person who's bought a property in Sydney. You know, that's the annual holiday budget, that's the cash reserve they had. So I think the Reserve Bank really need to keep an eye on mortgage distress, because if that starts to creep up, we may see the economy go into recession. So I think that we need to look to decrease interest rates sooner rather than later.
Former university students juggling, say, both a mortgage and a possibly large HECS debt got some relief today, Kerr, of that announcement by the government to wipe some of the value of the student debts off the page. So how will this work in practice? Because in reality, most students won't benefit from this until well down the track, right?
That's correct. Yeah, it is good news. It was announced by the government over the weekend. They're going to change the way that they work out interest on HECS debts. They call it indexation. So rather than use the consumer price index, which was 7.1% last year, they're going to use the lower of the CPI number or the wages price index, which was 3.2% last year. And actually going to backdate it to last year's start date. So that means that people who were charged 7.1% indexation, they'll receive credits to the tune of hundreds of dollars. So that's really good for those people who have HECS debts. And I've got two tips for people who have HECS debts. The first one is that if you want to reduce the level of indexation on your HECS debt, the key date that you need to mark in your calendar is 1 June. That's the date that the government applies the indexation to the HECS debt. And given that it takes about 5 days for the tax office to receive and process a voluntary contribution, if you want to make that, people who want to make extra contributions to their HECS need to start doing that now, given we're well into May. And the second tip is for people who've paid off their HECS debt. You need to tell your employer. If you don't, they'll keep taking out the mandatory HECS repayments out of your pay. So the way that you inform them is that you go to the tax office website, you download a withholding declaration form, complete it, lodge it with your employer, and they'll stop taking out mandatory HECS contributions.
Interesting tip. So let's finish with superannuation, important to a lot of Australians. Australia's second largest superannuation fund has done some research and found not nearly of us will have nearly enough when we retire. So take us through that.
Yeah, absolutely. So the Association of Superannuation Funds of Australia say that to have a comfortable retirement, a single person needs to have $50,000 per year income, and for a couple it's $70,000 per year income. So then the question becomes, well, how much do I need in super for myself to have a good retirement? And a lot of people say it's $1 million, but I actually think it's less than that. And the reason is that when you turn age 67, a lot of people receive the age pension from the government, which is quite a lot of money these days. So for a single person, it's almost $30,000, and for a couple, it's almost $45,000. So that means that the average person only needs an extra $20,000 to $25,000 per year from their super account to hit that quote-unquote comfortable retirement mark. So when you convert that to a number, it's sort of around $300,000 to $400,000 that people should be trying to save in super per person for retirement. But just keeping in mind that the age pension is age 67. So if you do want to retire before then, you do need to save up more in your super account.
James Gerrard, as always, thank you.
Thank you, Michael.
Okay, let's go back to the Met Gala cream carpet, we're calling it.